meeting to order. 3 members are present, 2 members are excused, Alderman Weigel and Alderman May. And kind of a motion to approve the minutes is printed
So
in our
moved.
agenda.
Second.
Any discussion? All in favor say aye.
Aye.
Opposed? The ayes have it. And then moving on to new and previous matters, we have a report from the Finance Director, Comptroller, submittal of the 2018 OPEB, Other Post-Employment Benefits Valuation Report. Ms. Steno, have at it.
Thank you. I have today with me Jack Shimoleski. He's from Milliman. It's the actuary who prepared our report, so he's gonna talk about the details, but I did send a memo, out with the packet, and I just wanted to mention, this is a really large, issue for the city. I know we've been talking about it a lot, from the council's perspective. Last year, it's kind of weird, they do roll forward, so last year we did a roll forward, but then we didn't include it in our audit. But it was 146.9 million in January of 17. Last year on 1/1 of 18, the roll forward showed 152 million. You all know about the changes that you approved as far as benefits, et cetera. And I'm very pleased to report right now, our balance as of December 31st, 2018 is 118 million. So we're doing very well. There's one small issue, that 18.5% should actually be 19.2% favorable change for the city's financial status. So I'm just gonna turn it over to Jack. He's gonna go through some of the report, and he's gonna talk to you about some of the assumptions that went into the report.
Thank you, Peggy. So our report calculates a present value of liability for the accrued benefits under the city's retiree medical plan. And so I'll break it into 2 pieces. The first are the retirees, current retirees, and then the second are the current active participants. So this valuation only looks at data as of the valuation date, so as of January 1, 2018. So for retirees, what we do is we have the medical coverage that they have currently elected and the percentage that they're responsible for. We project that premium out from now until forever, until they're no longer receiving medical benefits. That will change in the future, as there's currently a 10-year maximum on future retirees. But current retirees have a lifetime benefit under this plan. So we take these benefits, use medical trend to project those forward. They're currently, the city is only responsible for 50% of the premium, or $240 per month. So prior to this, the main difference from the last valuation to this valuation is that the post-65 was self-insured. I think it was last year it became fully insured. And so that did 2 things. First, it took the city off the hook from expenses greater than expected. And the second thing is the plan was made such that it lowered the actual premium amount. So both of those things factored into really helping. That was the main driver of lowering that liability from the expected 152 million down to 118 million. So that's how we value the retirees. How we value the actives is we take a current active, or every current active. We use assumptions such as withdrawal decrement, so termination from employment, disability, death, and retirement. Use all of those assumptions to project out what portion of that person will become eligible and take coverage from the city. So somebody age 35 with 5 years of service may only have a 20% chance of actually retiring from the city and accepting this benefit. So we roll all of those assumptions into our systems, calculate that, and project out when they become eligible for retirement, what portion of them will take the coverage, and then value the liability for the portion or number of years that they're eligible for under this coverage from the city. We take all of those numbers and project those back to today on a present value basis based on a discount rate that is somewhat mandated by the new GASB standard. And that's a 20-year municipal bond index. So you can see in the report behind you that for December 31st, 18, that interest rate was 3.44%. December 31st, 2019, that increased to 4.1%. That will keep fluctuating and be based on the same index every year. And a higher discount rate calculates a lower present value of the liabilities. So again, we project all these benefits out, the cash flow in the future, and then bring them back to today for a present value calculation as of each fiscal year end. So that's one of the reasons it went from 152 to 118, and then next year it'll be 110. The main reason for that change from 118 to 110 is the discount rate increasing from 3.44 to 4.1%. Anybody have any questions so far?
So you're showing us a good trend from 150 one year to 118 to 110.
Right.
What's the projection, or what do we have to do? Can we expect it to keep going lower and lower?
So
That's wishful thinking,
I made it
maybe?
a lot bigger. It is. Oh, it's really big now.
Yeah, there you go.
So here's what a roll forward from one year to the next. And I think to answer your question, if we look at the right column, so 2019 is a little bit more straightforward. So every year, we have a beginning of the year balance. We have what's called a service cost. That service cost is the expected benefit accrued for one additional year of service for active participants. So you're 1 year closer to retirement, you're earning a benefit. So that piece would expect the liability to increase every year. In addition, since this is a present value calculation, every payment in the future is now 1 year closer to being paid. So from that aspect, we'd expect it to increase. So from this year, based on these assumptions, we'd expect the liability every year to increase by about $7.5 million. Now, on the flip side, we have expected benefit payments, and those are in the $5.5 million. So saying that, without any changes, we'd expect this liability to increase by about $2 million every year going forward. That increase will change slightly based on future assumptions, actual experience versus expected experience, and also as more and more participants accrue under the new plan provisions, we'd expect that increase to decrease, if that makes sense.
So in layman's terms, we still have employees here that are gonna have post-65 benefits and longer than 10 years. But in the near future, like maybe we talked about 10 to 12 years, that's gonna go away, and after that, no one is gonna have more than 10 years of insurance or post-65 coverage. So we expect it to go up until that point and then start coming back down, but we don't expect it to go up drastically.
Right. And one other thing, so this is what's called an accrued liability. So for all active participants, essentially what we're doing to calculate their liability is ratioing their total benefit based on the number of years of service they currently have over how many they're expected to have at retirement. So if somebody's halfway through their career, their total liability will be divided by 2. So, and that's under the GASB standards, that's what we are told to value. So this isn't really, if you looked at a total expected liability, it would be higher than this, but this is what's called an accrued liability, which is ratioed for active participants. Retirees, it's the same because they've accrued their entire benefit.
Sure, Alderman Rowe.
Oh, yes. Is that the Governmental Accounting Standards Board? Is that GASB? It's an acronym for that?
That is correct, sorry about
Oh,
that.
okay, I
Yes.
didn't know what that was.
Right.
Okay, thank you.
Absolutely. Right, so we talked about the main driver in how the liability decreased from last year to this year, moving to that fully insured for post-65 benefits. So that really and moving to a Medicare Advantage plan versus a full coverage plan for that. A couple other issues or plan provisions that were changed that helped decrease the liability for this plan slightly. These are more future changes, so new entrants will be brought into these plans, are the fact that now more years of service in the city are needed to retire and attain eligibility for this plan. Another one that I mentioned a little bit before was that now there's a maximum of 10 years of coverage under the plan after retirement or up to Medicare eligibility age. So again, that's limiting the exposure of the number of years of coverage from the city. And finally, the share of the premium that the retirees are responsible for has increased slightly from what they were responsible for prior to this change. So those three factors helped reduce this liability a little bit, but it's really more mitigating future increases in the plan. One other aspect that I would like to discuss is the fact that this plan is unfunded. And that's a fairly common practice. I would say that under the GASBs that I have, probably 80% are unfunded, 20% are funded. It's something that it's a large number. You potentially, you look at options of funding it, but a lot of entities have decided against it as funds can be set aside. They're paying for these benefits on a pay-as-you-go basis. And I think the main thing is just understanding the future obligations and making sure you're ready for that. It doesn't necessarily need to be all in a trust, because there are some cons to funding and putting funds in a trust, that those funds then have to go to this benefit and can't be used for other purposes. So there's some pros and cons to each aspect, but you're in the majority as far as funding.
And so it's totally unfunded, not even partially unfunded. Is that correct?
That's correct, right.
Well, but when you say totally unfunded, be careful on that. It's annually funded. We fund the benefit on an annual basis, a pay-as-you-go. But we also have a fund balance reservation that I just asked you to increase from 8.8 million to 9.5 million. So we actually have almost another $10 million in the bank. If we had any gaps in budget years where we couldn't make it, we could use this, and that would go a long way. So funding is a little bit of a scary term. Unfunded sounds like we have this obligation, we don't have anything to do it. We do. We have a placeholder in our budget for about $3.5 million per year, which either covers or almost covers our obligation. And then we build that into our budget numbers. If we needed if something big happened, we took a real hit on insurance, we had a really bad insurance year, something like that, we could certainly draw on our general fund reserve just for this purpose for 9.5 million. So I'd say we're in the majority, but I think we're even a little bit better than the majority, because the majority that has pay as you go don't necessarily have $10 million in the bank to cover it. So it's not a terrible thing. And what he was saying about the funding is if you put it in a trust, those trusts are irrevocable. So something happened in the city, we wouldn't be able to take it out of there. So it kind of goes both ways on that.
Right.
Okay,
That's all I have prepared. Any additional questions?
great. No, nothing, anything else for the
I
committee?
don't have anything.
All right, yeah, thank you.
Thank you very much. If you guys have any questions, let Peggy know and she'll be in contact with me.
All right, yeah, thank you for this.
All right.
All right. Anything else properly before the Administration and Finance Committee? Then can I have a motion to adjourn?
So, did you see when he's back?
And so, all in favor, say aye.
Aye.
And then, so Administration and Finance is adjourned, and we will soon start the Committee of the Whole as soon as